Good afternoon, boys and girls. Welcome to Liberty Call. It is Wednesday, September 28th, 2022. Hope everybody's having a good day out there. Much better day for the markets here domestically. I guess people are buying the dip right now. So we'll see if if this is the bottom, which, if you've been listening to me on a regular basis, that's not quite how I feel, but definitely a reprieve from 6 days of negative negative days in the market here domestically. And I think we lost I was looking at the Dow, about 8 or 9% over those 6 trading days. So a little bit of a reprieve, but my personal belief is I think things are going to go lower, from here, at least for the foreseeable future, until we get some inflation stabilized and the money supply back in line. But it could be a little bit. So if it's your first time watching, please give me a big old thumbs up, like, share, subscribe, all that good stuff. I would greatly appreciate it. And let's go ahead and dive in and take a look and see how the markets did today. At least they look pretty good here domestically. The Dow Jones was up 1.88% or 548 points, closed at 29,683. S&P 500 up 1.97%, closed at 3719. NASDAQ up 2.05%. Tech was doing really well today. Closed at 11,051. Small caps are up 3.77%. The VIX fell 7.42% today. It's currently sitting at 30.18. Moving over to Canada, they were up 1.86. Brazil flat, up 0.07. Mexico up 0.97. Headed over to Europe, Germany up 0.36. UK up 0.3. France up 0.19. Euro Stoxx was up 0.2. Netherlands was down 0.25%, Spain down 0.05, Italy down 0.52, Switzerland up 0.93, and Portugal down 1.08%. The Russian exchanges were both up today. The MOEX up 0.53, the RTSI up 2%. Moving over to the Asian markets, Japan was down 1.5, Australia down 0.53, New Zealand down 1.19. The Chinese markets, the Shanghai was down 1.58. The SESE component down 2.46. The China 50 was down 0.9%. DJ Shanghai down 1.81. And the Hang Seng down 3.41, while the Taiwan weighted came in down 2.61%. So it looks like a lot of the negative trend we were seeing yesterday kind of was a contagion for most of the Asian markets. And things got a lot better as we headed through the day into where we're at right now. So, all right, let's go ahead and breeze through today's market recap. S&P 500 rides slump in Treasury yields higher. The S&P 500 rebounded from its recent malaise, supported by a fall in Treasury yields after the Bank of England's intervention calmed investor worries. The Bank of England said it delayed plans to begin its bond selling program or quantitative tightening and temporarily buy UK government bonds to restore orderly market conditions. Let's see. The move put pressure on UK government bond yields, which trade inversely to prices, dragging other sovereign bonds, including US Treasury yields, lower. Quote, there was a minor move lower in the Fed funds pricing for November rate move, end quote. So Scotiabank Economics said in a note. The 10-year Treasury yield slumped to 6.5%, pulling back from 15-year highs. Energy led the broader market higher, supported by more than a 3% rally in oil prices on supply disruption after 11% of oil production in the Gulf of Mexico was shut owing to disruptions from Hurricane Ian. Marathon Petroleum, Valero, and Hess were up more than 5%. Consumer stocks were also in the ascendancy, with home builders and retail lending to the upside. D.R. Horton, Lennar, Pulte were up more than 4%, recovering losses from a day earlier when data showed that home prices in July fell for the first time in 10 years at a time when rising mortgage rates have dampened demand. Technology stocks climbed, but lagged the broader market. The broader markets move higher despite the fall in Treasury yields, as a 2% slump in Apple weighed on the sector. Apple came under pressure on reports that the company is abandoning plans to boost new iPhone production, Bloomberg reported. Quote, the iPhone 14 just did not receive the same level of upgrades versus the iPhone 13 as the iPhone 14 Pro Max received versus the iPhone 13 Pro Max, end quote, KeyBank said in a note. Netflix, meanwhile, rallied more than 9% after Atlantic Equities upgraded the stock to overweight on optimism about the company's upcoming launch of a lower cost ad supported subscriber tier. In other news, DocuSign climbed more than 4% after it announced plans to cut 9% of its workforce as part of its efforts to cut costs. So I guess it's good if you're a DocuSign stock owner and bad if you work there and you're getting one of the layoffs. So anyways. All right, next up has to do with oil. Oil prices jump after U.S. crude and fuel stocks dropped and the dollar weakens. So I know I've said this before, but the dollar index has an effect usually inversely on things like precious metals, oil, most commodities out there, especially things that are sold in the global market. And when the dollar has been very, very strong over the last year plus. I know I was giving warnings to clients probably two years ago at this time, saying, "Hey, the dollar index has been falling. If we go below 90, that could be some real concerns." And since then, it has done nothing but climb. So but anyways. All right. Oil prices rose on Wednesday for a second day, rebounding from recent losses as the U.S. dollar eased off recent gains, and U.S. fuel inventory figures showed larger than expected drawdowns and a rebound in consumer demand. Brent crude futures settled up $3.05 or 3.5% at 89.32 a barrel. U.S. WTI crude futures ended up $3.65 a barrel or 4.7% at 82.15. Analysts said oil prices down more than 22% during the third quarter may be bottoming out as Chinese demand shows signs of rebounding and U.S. sales of strategic reserves come to a close. Quote, "I do think we are bottoming, but it is going to continue to be exceptionally volatile and continue to be keeping easy speculative money away from this market," end quote, said Rebecca Babin, senior energy trader at CIBC Private Wealth. U.S. inventory figures showed consumer demand rebounded, though refining product supplied remained 3% lower over the last 4 weeks than the year-ago period. U.S. crude stocks fell by 215,000 barrels in the most recent week, while gasoline inventories declined by 2.4 million barrels and distillate inventories by 2.9 million barrels, as refining activity declined following several outages. Refining activity dipped, but refiners are still running at 90.6% of overall capacity in the United States, the highest for this time of year since 2014 on both domestic and export demand. The dollar hit a fresh 2-decade peak against a basket of currencies on Wednesday before pulling back. A strong dollar reduces demand for oil by making it more expensive for buyers using other currencies. In early afternoon U.S. hours, the dollar index was down 0.9%. Quote, "These are all dollar-driven rallies across the board," end quote, said Eli Tesfaye, senior market strategist at RJO Futures. Quote, "All raw material dominated currencies are up. Crude is not just moving in isolation here," end quote. Goldman Sachs cut its 2023 oil price forecast on Tuesday due to expectations of weaker demand and a stronger U.S. dollar, but said global supply disappointments only reinforce its long-term bullish outlook. So, again, as the dollar is stronger, makes pushes down on fuel and other commodity prices, and at some point things are going to normalize, and oil will settle at whatever it should be. My personal guess is probably around $60 a barrel would be normal under circumstances where there's not a lot of issues, but we'll see. All right, and one last article here has to do with dividend investing. How much money do I need to live entirely off dividends? Here is the lowest amount you can probably get away with. Whether you're just starting out in your career or nearing retirement, the idea of stockpiling an investment portfolio to generate a passive income might be intriguing, but how much money do you realistically need to be able to drop out of the workforce and get by on dividend payouts alone? While you'll have to start by honestly assessing what you can live with and without, but there's a simple formula and some less simple risks you'll need to consider when making the big dividend dependency decision. Dividends are payments made by publicly traded companies to shareholders. They're typically used to communicate strength about the company's financial position. Steady dividends, even low ones, often signal a company's positive projection of its long-term outlook. Many dividends are paid in cash for investors with 401ks or IRAs. Dividends are often automatically reinvested and, through the power of compounding, offer a powerful tool to grow a nest egg. For straight-up equity investors, those cash payouts fuel dividend income, where passively generated payouts cover your living expenses. How much you'll need exactly depends on your income, spending habits, and living expenses, which means which means the answer is highly personal. But once you know how much you'll need to live, here's a simple formula to apply that sort out how much you'll need in total. Let's consider a desired dividend income of $37,522, which was the real median single person income in the U.S. in 2021, according to data from the St. Louis Fed. Next, consider what you can reasonably expect from dividend yields. It's fair to plan on yield rates between 1 and 6%. Using our formula mentioned above, here's how yields translate to a required portfolio size. A 2% yield, at a 2% yield, you'd need $1.876 million. With a 3% yield, you need $1.25 million. A 4% yield, you need $938,000. A 5% yield, $750,000, and a 6% yield, just $625,000. So you can see from a 6% yield down to a 2% yield, the balance of your portfolio would need to basically triple to provide that same level of income. As we'll see, the numbers need further refinement thanks to, or really no thanks to, taxes. There are 3 potential consequences you should be considered before you commit fully to this income strategy. First is taxes. Dividend payments from a taxable brokerage account or traditional IRA or traditional 401k or IRA accounts are considered taxable income. Downside risk: dividends aren't a slam dunk. High yield dividends may not be sustainable, and a company too focused on returning profit to investors could lose out on growth later. And sometimes without warning, today's higher dividends tank. If you plan to pay your bills with dividends, you'll need to feel the risk is both reasonable and worth it. Where was I? Oh, here. Too tight budget. If you can think and can manage expense at a median dividend income, then planning is everything. High inflation, rising interest rates, and global turmoil can do a number on your portfolio. You'll need a strong stomach and a stronger strategy. As housing is a foundational cost, start there. Should you move for the first time, median asking rents across the 2,000 threshold in May. According to Redfin, the numbers now range nationally from $1,453 in San Antonio, Texas, to more than $4,000. I would assume that's a month in New York metropolitan area. All right, so kind of gives people an idea as far as what you would need to have in a nest egg to simply just live off the dividends and not touch any of the principal. If dividend yields were all 6%, it wouldn't be that tough of a challenge. But triple that amount, it really, really gets tough. So, anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastic evening, and I'll be back tomorrow with Thursday's Liberty Call. If anyone needs anything from me, please go to DSAFinancialGroup.com. You can book a meeting. Drop me a phone call or an email, or just read through all the ways that I help folks with their financial planning. So hope everyone has a fantastic night, and I'll see you tomorrow. Bye.